Are you a smart investor? A smart investor plans for and invests according to their future needs and goals.
If you don't know what your goals and needs are, you can't invest to meet them. How much do you have to invest? What's your attitude to risk? How would you feel if an investment lost money? If you aren't sure, you should consider taking financial advice. Our leaflet, Investing for Smart Investors, contains handy hints to help you. You can find it in the consumer area of our website.
A smart investor understands that risk exists in all investments.
When you invest, your money is ultimately used to finance a business. For example, buy company shares and you buy a part of the company. Your risk is that the company doesn't do well, there are no profits and the value of your shares will fall. Buy debentures or company bonds and you're loaning a company money. Your risk is that the company doesn't do well and can't pay your interest or even repay the loan. Buy units in a collective investment scheme and your investment is shared across different companies. This diversification means you're less affected if one of the companies underperforms. Remember, higher risk may mean higher reward if the investment succeeds. However, there is a greater chance the investment will underperform or fail. You should only invest in line with your risk profile and tolerance for loss. Carefully select investments that fit your needs.
A smart investor recognises the power of compounding in the long term.
Compounding makes your money work harder. If you have a lump sum and do nothing with it, the amount doesn't change. If you invest the lump sum and the investment generates income, you may be able to reinvest that income. Income in subsequent periods would then be based on the initial lump sum plus all reinvested income, and so you can earn income on your income. Over time, this can substantially increase your returns.
A smart investor recognises the importance of diversification.
You can look at diversification as if you were a shopkeeper. If you only sold apples and the apple harvest failed, you'd go out of business. But if you sold a wide range of food and other products, your customers would have other choices if the apple harvest failed. Diversification means holding different types of investments to increase your chances of success. The key benefits of diversifying your investments are: you reduce your risk of loss. If one investment performs poorly, others may perform better, reducing the effect on your portfolio. You also preserve your capital. Not all investors need growth. Some who are close to retirement need to de-risk and preserve capital. And you generate returns. Investments don't always perform as expected. If you diversify, it means you're not relying on one source for income and growth.
A smart investor recognises the benefit of long-term, regular and diversified investment.
The key benefits of regular investing are: investing becomes a habit. Your regular investment is built into your budget. It takes emotion out of the equation. You don't have to make a decision about whether to invest today or next year. History shows that long-term investors are more likely to make money. Compounding works to your advantage. Long-term investing allows you to take advantage of compounding. It's easier to smooth performance. Holding your winners can moderate the effect of investments that underperform.
A smart investor conducts research on a product before investing.
To research a product, you should read all of the literature and the key features. What does the product do? How does the product meet your needs? What would happen if you need to take funds early or later? Are there other similar products available? Are they better for you? Do you understand the risks in the product and the product charges? Don't forget to read the small print. If you don't understand a product, don't sign up. Ask for more information or get advice.
A smart investor assesses the impact of fees when choosing an investment.
All products have charges which pay all of the companies and professionals involved. Fees should be clearly disclosed. A good way to assess fees is to read the product literature. If it contains a total expense ratio, also known as TER, this is a good indication of the total costs in the product. If you have an advisor, their fee might not be included in the product TER. Your advisor should disclose all fees and commissions they receive on your investment.
A smart investor avoids get-rich-quick and can't-lose schemes.
How do you spot a get-rich-quick scheme? Some red flags you should watch out for are coming up on the screen. The term get-rich-quick has been used to describe shady investments since at least the early 20th century. A get-rich-quick scheme will promise you high rates of return. Most schemes will create an impression that you can get this high rate of return with little risk and/or little skill, effort or time. The general rule of investing is, if it sounds too good to be true, it is too good to be true. Ask yourself, if this opportunity is really that good, why are they approaching me?
A smart investor verifies that an investment professional is licensed.
We publish a register of all Isle of Man regulated financial services firms on our website.
We hope you found our guide to being a smart investor useful. The Isle of Man Financial Services Authority publishes a range of guides in the consumer area of its website.